Welcome to Objective 4 in Unit 4 of Accounting 3310. This is an objective in examining how companies use assets that they've acquired via operating leases. Companies often use rented facilities and equipment rather than purchasing every location and every asset they use. We'll look at two types of renting: operating leases and capital leases. In this objective, we'll look at operating leases, the type of rental contracts most familiar to you as a consumer, in which the renter uses others' goods or for a short time. In business, though, operating leases can be more extensive and still fit in this category. How do operating leases appear in financial statements? At the end of this objective, students will be able to understand the use of assets through operating lease contracts. A lease is a contract that gives the lessee the right to use an asset for a period of time in return for periodic payments to the lessor. The advantages of leases are some protection against obsolescence. If you're working in a field in which there are rapid changes in technology, leasing allows you to trade out to the most recent version and the most recent style. Risk sharing in the extent of use of the asset and the value of the asset is another feature. That is, if someone else owns the asset and it declines in value, you can just hand that asset back to the lessor. It provides flexibility in use of particular assets, and there's no general debt to fund that asset purchase. Let's think about the entire spectrum of kinds of leasing. They go from the month-to-month type of lease that you may be familiar with on apartments to commitments for a non-cancelable one-year lease, so that one might be required to continue to make lease payments for the entire year, even if one is no longer using the asset. Moving up the scale toward owning are non-cancelable leases in which the lessee pays all of the maintenance. That is, the lessee is treating the asset more and more as though they owned it. And finally, as we move over a little bit more, a non-cancelable lease that is established for the entire useful life of an asset. That is very much like owning an asset, and yet the form of the transaction could still be leasing. When we're talking about operating leases, let me get back here. We're looking at the leases that are more like a rental, a lease contract that transfers only the use of an asset for a period of time without the rights and responsibilities of ownership. Capital leases are the term when the rental agreement is more like ownership. That's a lease that transfers the rights and responsibilities of ownership of the asset from the title holder to the user of the asset. If a lease contract meets all of the criteria below, the lease is going to be considered an operating lease for accounting purposes. The leased asset cannot revert to the lessee at the end of the lease in a title transfer, which involves no payment for the asset, no additional payment for the asset at the end of the lease term. If there is a title transfer, then it's just as if the lessee owns the asset. So that feature cannot be included in a lease that's going to be considered an operating lease. The second one is, the leased asset cannot revert to the lessee at the end of the lease with a bargain purchase. A bargain purchase is a payment that's clearly less than fair value. Again, if the lessee is going to end up with ownership of the asset, then that is not an operating lease. The next criteria is one that is perhaps a little harder to explain. If the term of the lease for an operating lease must be less than 75% of the economic life of the leased asset. So this 75% criteria was set by the Financial Accounting Standards Board, and there's not any real reason why it needs to be that specific number. The general idea here, though, is if you are using the leased asset for most of the life of the asset, then you are more like owning the asset than you are using it on a rental basis. The specific number that's used as the threshold here is 75%. The next one also has a very specific number in it. The present value of the future lease payments must be less than 90% of the fair value of the leased asset for a lease to qualify as an operating lease. Again, Financial Accounting Standards Board picked out that particular number of 90%. But the idea here is that if you are using most of the value of the leased asset, then it's more like owning the asset than it is like an operating lease. So, if one wants to use an asset and have it considered for accounting purposes an operating lease, these are the kind of features that the lessee is going to make sure are included in their lease. They're going to make sure the lease has no title transfer and no bargain purchase. They're going to make sure that the lease is short and uses renewals that are at market rate to keep it below that 75% of economic life criterion. And they'll try and keep the amount of the value of the asset down by making sure there's no guarantees of any particular residual value that could increase the lease value above the 90% fair value criterion. So since the company knows what the criteria are, leases are often designed specifically to result in a particular kind of accounting result. Next, let's talk about operating leases on financial statements. The future payments on non-cancelable operating leases are disclosed in footnotes to financial statements, but they don't appear on the list of liabilities on the balance sheet. Non-cancelable operating leases do in fact increase the financial risk of a company, the same as any other obligation, but users of financial statements need to do their own adjustments to liabilities after looking at the footnote to identify the additional financial risk that's possible from operating leases. Now remember, if it's a cancelable operating lease that the company can walk away from, then that's clearly rental and does not accompany any significant financial risk. For example, in the 2012 McDonald's annual report, they report a sum of $12,522,000,000 in non-cancelable operating lease payments. That is the sum of all the payments, and it's not discounted, so it is going to be larger than the present value of those future payments. But in any case, $12 billion is a lot of money. And that happens because most of the facilities of a fast food restaurant are leased rather than owned. Note that McDonald's has $20,029.9 million in liabilities on their balance sheet, so it would be a significant increase to the liabilities on the balance sheet if those non-cancelable operating lease payments had to be included as liabilities. Let's look at the accounting for operating leases. The lessee is going to record the use of cash as a rental expense. That rental expense is a debit because it's a decrease in owner's equity. The credit to cash means we have a cash outflow. One of the issues with operating leases is sometimes lease contracts have special features in order to encourage people to sign on to a lease agreement. Usually, lease revenue and expense is the same each period, but some agreements can postpone payments until later in a lease term or require larger initial payments primarily for marketing purposes. The accounting result is that we're going to recognize lease expense and revenue evenly over the period of the lease, recognizing prepaid rent or rent payable as it's needed to spread out those payments. An example of that kind of lease is available on this next slide. Let's say ABC Mall is advertising free first and last month's rent when a lessee signs a non-cancelable 12-month contract for $300 per month. This is uneven rent because there's zero rent in the first month, $300 in the second month. So is it that the company really has no rent expense in month 1 and $300 of rent expense in month 2? Not really. What the company has is a total of $3,000 of rent for the year. They're paying rent for 10 months times 300 based on the terms of the lease. That $3,000 of rent pays for rent for the entire 12-month period. So the company should divide that $3,000 total payment by 12 to find the monthly rent. So even though the lease contract doesn't say the rent is actually $250, a $50 discount each month, that's what in fact is happening. And the company will record rent expense of $250 in the first month even though they are paying no cash. That represents rent payable. Then in the second month, they also have rent expense of $250 even though they pay out cash of $300. That extra $50 goes toward the rent payable. Let's mention leasehold improvements, which we mentioned previously as an intangible asset. Companies may lease rather than own premises, but still invest money to customize and improve the property. The accounting result is that on the accounting books, one would need to recognize leasehold improvements an intangible asset for the extent to which the company has fixed up the leased facility with fixtures or other improvements that will revert to the lessor when the lease ends. These leasehold improvements are amortized over the life of the lease rather than depreciated. Here's an example of leasehold improvements. Our company has a retail location in the mall and changes the lighting and puts in a changing room, even though these items will stay with the location when ABC Company's lease ends. ABC Company paid $5,000 for the improvements and expects to remain in the location for 10 years. At the time that the lighting change and the changing rooms are put into place, they're recorded on the books as $5,000 of leasehold improvements. That's a debit because it's an increase in an asset. Then at the end of every year, just like any other intangible asset, we're going to amortize it over its useful life, which is the life of the lease of 10 years. This is the end of our discussion of operating leases.